Thanks, guys, for that. We're going to move right away to NerdWallet. Brian, you found this one, right? You sent this one to me today. The best home improvement loans for June 2025. And this is relevant because we've been talking about HELOCs a lot, but it's not the only solution. It's a solution that we can offer. But I want to talk about these home improvement loans because I know that people are hearing about these. There are a couple of pros. I think I see more cons in this situation than pros, but I wanted to talk to you guys about it and get your take on it. So this is when people are trying to get financing to upgrade their kitchen, or they're trying to bring their house up to snuff, if you will, and look more like the neighborhood houses. If you've been going 10, 15, 20, 30, 40 years without painting your house, putting a new roof on, swapping out those windows, putting a new garage door in, there's some deferred maintenance there, and then this might be the way. So where do you guys want to start with this one? And take it away.
So one of the things I noticed from the beginning was that this was a complete different, just like a personal loan. So although it does help you, get your reparations done or additions or whatever it might be.
Wait, reparations?
I mean, restorations.
Restorations. I got it.
I know. I just wanted to make a pit stop at reparations real quick.
You know what that means, right? Okay, anyways, moving forward.
Hey, I'm getting this personal loan because I owe reparations. Like, that's what I'm going to take it out of my house and pay my reparations from my equity.
So,
dang, dude.
So one of the things that I did notice is that I think it comes down to people's situation and priority. And that's going to be the biggest kicker, because if let's say your roof caved in or your roof is broken and you really need a new one, maybe you can't take a route that's going to take a little bit longer, although it might be a better deal. You need that solution now. So I think it comes down to your situation and how high of a priority it is that you need that money. So for example, if you know that you want to make some additions in the summer and it might require for you to get some permits, you maybe want to look into something that's, that gives you a little bit more flexibility, like a HELOC or a cash out refinance, where you're going to be able to, not off the bat pay that whole full amount, but maybe ease into your payments and be able to have that budget there ready for when it's needed. On the flip side, if your situation needs an instant solution now, then you're probably better off doing a loan like they mentioned in the article, where it's going to be very quickly accessible, but it does come at the exchange of, higher rate, higher terms, where, home equity line of credit for the average part, the rates are in the single digits, where a personal loan or a loan like this, it's going to be in the double digits and low double digits, to start off. And that's having like the best of the best in credit tiers.
Yeah, it's kind of like, it's weird. I was thinking about this today. It's kind of like in this sweet spot. It's in this like no man's land. It's in this dead zone. God, I'm having a hard time getting my words out today, guys. I'm so sorry. It's like in this no man's land dead zone, where it's like maybe the credit's too bad that you can't get a HELOC. You might have equity, but you need to do the work on your house, and you can't qualify for a home equity line of credit either because your income's bad or your credit, whatever. Like, even in this article, it's like if you have a credit score between 300 and 629, I'm like, geez, 300. Even if it's 620, like your percentage rate's maybe 20%. Like, that's really high. HELOC's definitely not that high. You definitely got a credit problem. But if you don't have another choice, this is your choice. Even at like 640, 660, it may not be favorable compared to a HELOC.
Yeah.
But if you can get that 720, 740 or higher, then the HELOC might be right around the same rate as something like this. But then this is the other issue. What about the amount that you need? If you only need 30 grand or 40 grand, that's different than needing $100,000 or $200,000 out of your house. So maybe you don't need to take such a big chunk. You can do the smaller thing here and pay it off a lot quicker than it would be if it was a home equity line of credit. Just depends on the situation.
Yeah.
It really does.
Yeah. So what would your advice be to somebody who maybe can't qualify for a HELOC? Well, actually, that's not what I want to ask. Do you think that still trying to qualify for the HELOC first is better than taking a loan like this? Or should they look at a loan like this first and then go to a HELOC as their second option?
My answer would be to really understand your situation, because that's going to tell you the urgency that you need to move in. So if you know that you need to move quick, maybe lean towards, that like construction loan or that renovation loan, because it's going to be a little bit faster on the process, maybe the qualification as far as, what documents are needed. But if you have time and, you want to have the opportunity of perhaps paying less in fees or paying less in interest, then, look into, leveraging your home equity, because that's going to give you a lower payment. If you have good credit, if you're not, drowning in debt, that's going to allow you to access funds in a way where it's accessible if you need to, use some amount, not the full amount or all amount at once, rather than, paying that full amount at once. If you get that construction loan, you're going to be able to just, pay for what you need as you're getting it.
It's kind of like, it's like one step short of a hard money like a straight up hard money loan. I can also see based on like the description and the definition, it shares a lot of the same characteristics as a hard money loan. The interest is a little higher, the term's a little shorter. In this case, you can apply online, get an answer in a couple of minutes, if you will. But I'd say if you're going to use the money for, I say 12 months or less, and I would say definitely focus on the less part. Like if you can pay back in 3 or 4 or 5, that's going to be much better off that way than going to 12. If you need 12, then you need 12. That's just a situation. If that's what it is, then that's what it is. But it basically feels a lot like a hard money loan, and I don't necessarily think it's bad. I mean, I'm going to go back to something we talked about with HELOCs last week. If you're using home equity line of credit in order to pay off debt, like you have personal debt and your house is bailing you out, that can only be good for you if you also address the behavioral problem that caused the debt in the first place. If it was not a life event or something major and catastrophic that caused the debt to be taken in, then we have a spending issue and a budgeting issue to talk about that is going to long-term help you more than just paying off your debt once and then calling it a day. In this situation, if there's work that needs to be done on your house to maybe outfit it to fit your senior parent or to fit yourself, you have to make modifications to how you get in the house, how you get out of the house. You have to make repairs. You got to bring it up to code if it's out of code. Like there's situations I can see where people might need to use this kind of money. And if you don't have income, at least to qualify for a HELOC or the credit, then this is probably your best choice. Or maybe only choice.
Unless you're in dire need,
Yeah.
something like this would stay place. That's my opinion. Especially when there's a lot more options out there. Like there's your Fannie Mae, your Freddie Mac, there's FHA 203K. There's a lot of other financing opportunities where you can finance certain renovations. A home equity line of credit can serve 2 purposes. It can serve the purpose where if you're looking to do renovations to it, then utilize the money for that. But there's times where you may not need so much because a lot of times we think, okay, so I'm going to need renovations like $150,000. Next thing you know, I got a friend that knows how to paint, knows how to do this. It cost me only $75,000. What am I going to do with that extra $75,000? Maybe I can pay down a credit card, or maybe I can put that money into an investment account where I'm going to probably earn a little more money. Who knows? We don't understand that person at that moment. It's just good to have options, So I think this information and advice is really good, but it really pertains to that. You have to identify that person that's going to fit what mold.
Yeah.
I totally
This is why I was going towards the hard money analogy, is because it's kind of like if you're just cornered into it and like that's your only option, then that's the one you got to take. And I'd say last thought for me is if you're taking $10,000, $20,000, $30,000, that's most likely going to be able to be paid back pretty easily. If you are also agreeing that that's what you can take out, do it. If you're last resort is what I'm saying.
Yeah.
My perspective was along the lines of that. Why utilize, another type of debt when you have one that's very secure, low interest rate, and it's more stable for you to be able to pay back because you're always going to pay your house before you pay your debt. So I feel that that's going to be a little bit more of an accessible route if you're a homeowner. And if you're really looking at the route of taking a regular loan like that, really, really think about it because down the line you might regret your decision.
No, absolutely. I mean, the cool thing about that, it says that there's no lien attached to your property or anything like that. It doesn't, and if you did miss the payment for whatever reason, it doesn't affect your credit scores.
Yeah. No, it's an unsecured loan is what it is.
Yeah, it's unsecured loan. So that's what you get with that. But
Yep.
obviously, they're putting more of this information out there because we're starting to see a lot more people pivoting into it, going into different directions.
There must be a demand for this if there's
There
a
is.
product on the market for it. So if there's a product for it, that means there's demand. And if that demand's being met, then there's going to be money on the back end that people are making. So
Yeah. And we're seeing it here in San Diego, particularly because of the whole ADU, the accessory dwelling unit rules and regulations. People are just saying, well, I can convert my garage out. What can I add to this to our growing family so I don't have to displace myself? How can I just do a loan? So we're starting to hear more of this stuff.
Yeah.